What if visiting Australia for just 46 days a year, even just to see your mum, attend a wedding, or renew your passport, could pull you back into the Australian tax system and worse, force you to pay years of back taxes on your global income? Well, that's exactly what the Australian government is proposing right now. And if it passes, it could impact thousands of Aussies living overseas, even the ones who've done everything right. Take Megan. She's a digital nomad, a freelance writer. 5 years ago, she packed up and moved to Portugal. New country, new tax residency, new life. And she did all the right things. She registered as a Portuguese resident. She opened local bank accounts. She signed a 12-month long-term lease. She got her NIF tax number and kept lodging non-resident tax returns in Australia, declaring rental income she received from her investment property. Every year, she came back for brief visits to see family and friends, 2 weeks in January, a wedding in May, a short trip in September, never more than 60 to 70 days in total. No big deal, right? Well, not anymore. Right now, Canberra is reviewing a proposed change to Australia's tax residency laws. It introduces something called the 45-day rule, and it's part of a broader factor test. Under this proposed rule, if you spend more than 45 days per year in Australia and meet just 2 of the following 4 conditions: 1, you have Australian citizenship or permanent residency; 2, you have access to accommodation, even a family home; 3, you have close family ties; or 4, economic interests like a business or superannuation, then you could be reclassified as an Australian tax resident. Yes, even if you live overseas full-time, even if you pay tax elsewhere, even if you haven't earned a cent from Australia in years. Now, imagine Megan sitting in a cafe in Lisbon, sipping on her latte. Life is good. She opens up an email from her accountant. Hey, Megan, have you seen the new 45-day rule? Suddenly, everything changes, because if the ATO deems her back in the tax net for the last 2 years, that means that Megan has to pay taxes on her global income. She'll be hit with interest and penalties and a possible compliance investigation, and the life she carefully built overseas now at risk of falling apart. Now, this law hasn't passed yet, but it's on the table, and the ATO is already watching expats very closely. While this rule hasn't yet passed into law, it has been accepted by the government in principle and is under active consideration. And if enacted, it may apply retrospectively, meaning it could impact you from the date of the announcement, not just the date of when it becomes law. So here's what you need to do now. Track every day you spend in Australia. Yes, even partial days. Make sure you build a clear paper trail of your life overseas: leases, tax returns, utility bills. Cut off all unnecessary ties to Australia. Review your super, company directorships, and family financial links. And most importantly, get a tax residency compliance letter. That letter is your legal proof, your protection, your ACE card if the ATO ever questions you. Don't wait until this law passes, because once it's law, it might already be too late to fix it. And here's the kicker. This isn't just about counting days. It's subjective. It's based on factors. It's based on perception. It's based on the correct sequencing. You could follow your heart home and walk straight back into the tax trap. So if you're an Australian expat living abroad or thinking about making the move, don't leave your tax residency to chance. Don't assume that just living offshore means you're out of the system. And don't wait for the ATO to come knocking either. Talk to a strategic tax advisor who understands both international law and Australian tax law, someone who can help you bridge the ATO compliance gap and ensure that you're covered from an Australian perspective. Review your residency status and protect the life and freedom you've worked so hard to build.